Why is Bitcoin at a 6-month low? The NASDAQ is down almost 3.5% this week. Is the AI bubble bursting? How can you make safer money from stocks powering AI? And why does my son look so much like the mailman? Just kidding. I will have answers to most of these questions and 3 stock ideas in this week's Curia Investment Show. As usual, I am joined by 2 fantastic investment experts, Eoin Tracy and Simon Erickson, neither of whom looks like my son, by the way. Thankfully, Eoin Tracy is from Fuller Tracy Money, and Simon Erickson is from 7 Investing. Guys, welcome as usual.
It's always a pleasure.
Glad to be here, James. Always enjoy your sense of humor to kickstart the morning.
Yeah, that's kind of borderline tasteful. That's about the. I think that's about
edgy.
That's the guardrail. It's a tough market these days, Simon, for jokes. But that's about as far as I'll go. I feel a little. I need to take a shower after the show, actually. So let me start with a fun fact on happier notes. More cleaner note, let's say. Where do we go here?
We apologize in advance to anyone tuning in to today's live stream show.
We do apologize.
It's only going downhill from here.
Oh, my bad. I don't know where this fun fact went here. Here we go. Sorry, this is a fun fact. Is James Early is not very technically savvy with this Riverside here. Here we go. You've probably heard that. Can you guys see this? Is it showing? Yep, here we go. That day trading is risky. Well, this is a study from 2017. Brad Barber, by the way, is a very well-reputed academic. This is on Taiwanese investors, but I think it applies universally. Basically says 95% of day traders lose money. That's not beat the market. That is actually outright lose money. So if you think you can be in the 5% who does not lose money, great, good for you. But you're probably not. You're probably going to be in the 95% if you do day trade. So public safety announcement of the day. All right, so back to the matters at hand. Bitcoin.
Well, one thing about day trading is that everybody lives for that 5%. It is a gambler's market, and a lot of people made a lot of money during the SPAC booms and the meme booms of 2020, 2021. So they're dyed-in-the-wool day traders. They don't really care if they're losing 95% over the long term. They just want to make that 5%. They want to be in that 5% at exactly the right time.
That's a good point, Eoin, in the sense that even if it's economically irrational, when you are in that 5%, it feels really, really, really good, right? Yeah. And that's probably a very strong anchor, a very strong memory. Like, damn, the time I went to the casino and actually didn't lose money. I made money and then I left. I went to the parking lot and drove out, before I could blow it again. That's probably disproportionately weighted in our brains, right? We're creatures of cognitive bias, and so it's a lottery ticket fallacy too, right? Chasing that the one time it does win feels extra good, and that's why people do it.
Yes.
Or just the aspiration, even if you didn't win. Anyway, but if it's you watching, that's probably not going to be you. And so you're probably not going to feel good enough to make this a worthwhile thing. It is, the markets are becoming more gambling oriented, I feel like. Gambling is more fun than investing. Let's face it, it just is. And the lines have always been a little bit blurred, but I feel like they're more blurred now than ever. Speaking of, I don't want to call Bitcoin gambling. It's not, that wouldn't be fair. But speaking of riskier, risk-on type assets, Bitcoin is certainly near the top of that group. Crypto in general as well. So, Eoin, I'll skip the long preamble. Bitcoin is now at a 6-month low. Maybe it's because investors feel less certain that the Fed will cut rates in December. At least that's what some of the headlines say. I did see, though, that Eric Trump, of all people, says that Bitcoin is up 70% annually over the past 10 years, which I believe. You've written to your subscribers about this. What's your take?
Well, this is a really big point here because, Bitcoin is now below 100,000, and 100,000 is a big level. It's the region of the 200-day moving average. It's the upper side of the underlying range. And it's the kind of headline number that a lot of people wished that it got to, and then were hoping it would hold when it got above it. Now, I think the market right now is sending a very clear message to the Federal Reserve. They need lower interest rates. If you want all this money and all this speculation to persist, then you've got to cut rates. And if the Fed, and there's a lot of Fed governors over the last week, have been kind of hawkish, and they've been talking about, well, maybe not, maybe we're not going to do it, maybe we'll wait for more data, we might hold off a while. The market doesn't like that. And this is really important for Bitcoin because Bitcoin is highly cyclical. There's a 4-year cycle in Bitcoin. And it was particularly interesting in 2024 because for the first time ever, Bitcoin was at a new high before the halving. Now, what that told us was that there was a lot of people were getting really interested. They were really attuned to the cyclicality of Bitcoin. They knew that after a halving, prices go up. So they bought before the halving in anticipation of that move. But let's also remember that Bitcoin doesn't just go up, it also goes down. And there are things called crypto winters. And those winters are also highly cyclical. And they generally happen they start about 500 days after the halving. Well, 500 days after the last halving was September of this year. And that's when Bitcoin peaked. And it has been going down since. So that's why I say we are at a critical juncture right now. If we don't see more liquidity coming in, and I have been describing Bitcoin as a liquidity barometer for about a decade, it does particularly well when you've got lots and lots of money getting created. And without that, it's going to struggle. And we're in a cyclically bearish period now.
So Bitcoin basically does well when there's money creation, M2 money supply, whatever it is. When you have more money around, it just tends to go into Bitcoin. Interesting because, you know, I offered this, I guess, economic explanation, which is maybe the Fed won't cut rates as much as people were thinking before, therefore Bitcoin is going down. You took kind of a cyclical explanation path, Eoin. Is there a logic that you're aware of to this 4-year cycle in Bitcoin, or is that just like based on observation of what's happened in the past and therefore it's probably going to continue, or is there like some underlying mechanics?
Well, the simple thing is Bitcoin's a limited supply asset. So every time there's a halving, it gets twice as expensive to mine. And that drives some of the miners out of business. And then it becomes more expensive, and that pushes up the price in terms of how expensive it is to supply a new Bitcoin into the market. And that is the foundational price of where you can expect the price to find support will be the marginal cost of production. That's the same for every kind of commodity, and it's exactly the same in Bitcoin. Now, that halving, not only does it increase the cost of supply, but then it bolsters this whole idea that there's a limited number of them and that there can't be more. So then it just creates this sort of interest in the market. But then there's been just this very happy coincidence that every time there's been a halving, there's been a big increase in money supply or interest rates getting cut or quantitative easing or fiscal excess. And that has helped, in addition to the halving, to push the price up. This time around, we had lower interest rates. We had the new Trump administration going out and talking about how great Bitcoin is. And you have the president saying, we're going to have, he has his own meme coin and his wife has her meme coin. I don't think it could get any better for Bitcoin, but the price not going up. So that tells us that that was the peak. That was the peak of enthusiasm. And now we're coming more into the downward cycle where the halving influence has kind of waned now. And we're waiting for the next bullish cycle, which would coincide with more interest rate cuts, with more quantitative easing, but it's not there yet. So we go down before you get a recovery in future.
Interesting. So I think we need our own meme coin, by the way. But it sounds like, I mean, one of the biggest things, and I'll move on in a second, but for me, it's like, what is Bitcoin? Is it a currency? Is it a commodity? Is it just some kind of this weird risk asset? It sounds like you, Eoin, put it in the commodity bucket. Is that correct?
It's a risk asset with commodity characteristics.
Nice, nice. All right. So speaking of risk assets, as I put my glasses on to read the exact data on this. It's not just crypto. The markets are dumping. The NASDAQ is down 3.5%. The Dow Jones Industrial Average is down just 0.33% this week on reportedly fears of interest rate cuts being less than expected, maybe fears of economic data that wasn't very good, that has yet to come out because of the government shutdown, and perhaps talk about the AI bubble, which, of course, everyone is talking about. Michael Burry, a famous short seller who was short right before the 2008 housing crash, that's kind of his claim to fame, recently shut down his business. Scion Capital and Hindenburg Research, another short selling shop, closed in January of this year. So it has not been a good time to be a short seller, although maybe they just weren't patient enough. I'm gonna show a few charts. Actually, no, I'll just cut to the meat here. So, Eoin, you and I emailed a little bit about how, I'll say it from my perspective, everyone's talking about this potential AI bubble. And when enough people start talking about a bubble, maybe it can be a real thing. Economics is a social science, and we saw that in 2008, 2009 too. Housing bubble was a thing for a year and a half, then suddenly it actually manifested in economics, right? I noticed, though, like I mentioned at the start of the read of this, NASDAQ down 3.5%, Dow Jones just barely down a touch. So this is very, very central to tech. This is a tech decline. All those big tech names are down this week as we're recording. You mentioned ETFs being kind of like a tipping point, a catalyst, almost like the reverse of a short squeeze in a way. Can you elaborate a little bit on that? This could be a logistical catalyst that could bring the market down further.
You have to think that the big mega cap companies, they represent a very large weighting within the indices. So how do most people own those big stocks? Do they own the individual shares, or do they just own the index? Now, if most people own the index and they want to sell their big stocks, well, they just sell the index. And then the ETFs hold all of these shares. So they don't just sell the bigger stocks, they sell in increment across the entire index. And they do that on a market cap weighted basis. So you're going to have a knock-on effect. This is effectively contagion selling, but within an ETF. Because if you have a deeper pullback and you have more people selling, then the ETF has to reduce the number of units. And then they have to then that means that they have to sell everything. And they sell that down. And then what selling begets selling. And I think this is very similar to what we had at the end of 2018. Because 2018 saw Jerome Powell get his job. And back then, the market went down 10% as soon as he was appointed. And that was really to try and test his resolve. And then the market started going back up because the Fed said they were going to hold off. They were going to continue to supply liquidity. But then as we got through 2018, they started raising interest rates again. And that was really something that the market didn't like. So at the end of 2018, the market sold off by 20%. And the plunge protection team was convened over the Christmas break, and they had everybody come in and said that the Fed was going to stop raising interest rates, that they were going to engage again with quantitative easing, or they were not going to restrict liquidity, and that you had all the banks saying that they were going to go out and start buying. So I think we're kind of looking at something like that. Because in 2018, everything went down for about 6 weeks. And it was really a fear around interest rates. And I think that's exactly what we have right now.
So I mean, maybe this is the poor man's way of explaining what you explained, or the less articulate man's way. But on the ETF point, just itself localized, there's been an argument made by the people who support, let's say, RSP, the equal weight index, or just general stock picking, say, hey, look, guys, when you're buying S&P 500 ETF like SPY, we got 10% of 10 companies or 40% of the U.S. market cap, and the ETF mindlessly buys those, and is forced to buy at higher and higher prices because its only job is to mindlessly construct a market cap weighted index. Well, guess what? As those start to go down, the ETF has to faithfully follow an index strategy. Therefore, it sells those stocks. So the strategy gives and the strategy takes away. Not even a strategy, it's just a computer model, but that's the effect. So compound that with all those other things. We have reasons to believe that when it goes down, it can really go down. Is that accurate?
Yes, and it's unrelenting and indiscriminate selling. That's the most important point.
Unrelenting and indiscriminate sounds scary to me.
I think the most important point is indiscriminate, because if you're selling the index, yes, the large cap companies have the biggest weighting, but they reduce their holding in everything when you reduce the number of or the amount of money in an ETF. So they sell everything. It's not just the big companies. Now, the big companies will have an inordinate effect on the index, and particularly at the top. Now, after say a 10% pullback or even a 20% pullback in the large cap companies, their weighting within the index is not as powerful. And the indiscriminate selling means that you get real value. So then it turns into a real stock picking opportunity, because you can then get really attractive value opportunities because of the indiscriminate selling, and then you get new leadership forming. So these kinds of events, you have to be aware, but you also have to bear in mind that it's going to create a really attractive value opportunity.
Simon, in regards to this unrelenting, indiscriminate selling, it seems like, just based on the companies you select, you've got a few of those big cap ones, but you also do a lot of individual, like sniper style stock selection among those, the rubble, let's say, or maybe it's not even the rubble. It's just the stock's not affected by that landslide. If that landslide happens, again, it's not a foregone conclusion, but I tend to think Eoin is prescient here, that things go up, things go down. What's your take?
Yeah, I agree with everything that Eoin said. I mean, there's indiscriminate selling with the indexes, no doubt about it. A lot of it's just people getting out, right? The valuation multiples are coming down. The fundamentals still look strong. I just think that right now, if you're an individual stock picker and you're going after those spicier, riskier names that are not at the top of the index of the S&P, Thor's hammer will come down on you very hard if your company misses earnings or whiffs on forecast right now. We've seen this several times. Stocks selling off 25, 30% this last month. We just went through earnings season. And if you gave a less than stellar forecast for the fourth quarter coming up, shoot first and ask questions later. There's opportunities from sell-offs triggered by just guidance that isn't what the street wants right now. Even more than it always is. It's always been that way, but even more right now, James. Yeah,
and I've just had, the straw that may break the camel's back, at least in my view, is AI, and I've had this up on the screen. We haven't talked about it, but a pretty good Wall Street Journal article that goes through a few different charts on AI. When AI hype meets AI reality, a reckoning in 6 charts by Christopher Mims and Nate Ratner. This is the data center build out, stalled, planned. You can see we don't actually have that much built. We've got a ton of stuff that's planned. Capex is huge, and these companies are spending. They're borrowing now. Insurance companies are buying the debt because the private market only has so much money. There's just a ton of money going into AI, and if the forecasts are accurate, we're going to need a ton more power. But if the demand is not as high, or if these things just can't get built anywhere near the expectations the market has, then we're going to have unmet expectations. And when you have unmet expectations in the market, you have prices that go down. It's that simple.
Yeah, and we've got
something else. Just think about it this way: is that the big limitation right now is power. And we don't have enough power plants. You have data centers that are building their own. That's kind of behind the meter power plants. Well, if you have a supply constraint on electricity, the real way to fix that is to come up with a way for a data center to use less power. So that would be a really significant innovation. And the longer we have a supply crunch in energy, the more likely that is. But then that would also mean that all the money that is getting poured into building new data centers that would be wasted capital. And the reason I kind of pay attention to this kind of story is this is exactly what happened in the 1990s.
Yep.
There was a huge build out of the network capacity, but then engineers figured out how to put more data through the existing networks. So then there was a massive overbuild. So we're kind of looking at that possibility. If we have an efficiency gain in how data centers use energy, then that would be a really significant innovation. And I think it is more likely than not over the next couple of years.
I'm not sophisticated in the innards of a data center, but it might be a bit like in the late 90s and 2000s, like all the new houses and apartments that came out had like multiple phone jacks, because that's how you connected to the internet at the time, right? And now, you know, then we went to coaxial cable and Fios, and it's all Wi-Fi now. But like investing massively in a build out that doesn't have staying power sounds scary. But I'm sure these chips are much more robust. And Simon, you can probably speak to this in a lot better terms than I can. And I teased at the top of the show, one of the things we talk about is power as it affects AI, because that seems to be the safer play. I'm just going to share something on the screen here that relates to what we were just talking about here. This is from BlackRock, U.S. data center power as a share of total. The gray bars represent the range of estimates. The red is the expected demand going out from 2024 to 2030 is the last bar in the chart. And the green is the expected supply. And so, like, that's bad news if I'm buying an AI company. That's bad news if I'm expecting some AI output, because it seems like they're going to be highly constrained, to Owen's point, by the power. It might be good news, though, if I'm buying a company that's supplying power, because guess what? I mean, they can't build it fast enough. What are your thoughts on this sector?
Oh man, two beer conversation, James. You know, how deep into the rabbit hole do we want to get? I think that maybe if we stick to the highlights and the high points on this, everything we've been describing is exactly why no one is catching Nvidia.
Mm-hmm.
Everyone's going to come up with new, cutting edge chips that are really cool and can do really cool things. I mean, ASICs have been around for decades, but in terms of the number of trillions of floating point operations per second that is consumed, they're allowed to be executed per watt of power. So teraflops per watt of power in the data center. No one's going to catch Nvidia on this. It's just going to keep incrementally getting better and better. And they're going to sell more and more chips. And we know that those chips consume a lot of power and they also run really hot. And so the data center, I've been doing a deep dive of the data center here for this last month, James. And as I descend even further into this research rabbit hole, you see that, yes, there is the power demands. We talked about Schneider Electric on this show last month, a France-based company that does a lot of the power systems. And there is certainly a supply shortage right now. It's taking 3 years to get transformers installed for data centers. Transformers, simple industrial products, things like this is just taking ridiculously long, because this is the bottleneck of getting these massive infrastructure spins to actually come to fruition. And the other thing that I do want to mention, that there's a power supply shortage. There is NVIDIA is going to continue at the top when it comes to cutting edge chips. And then the third part is the coolest part of the entire market. Literally, the coolest part of the market is cooling data centers. You've got to do a lot of cooling, not just for the server rooms themselves. We also mentioned, I believe last month on this show, Train Technologies, HVAC systems, and applied HVAC for data centers is huge in demand right now.
That was the faux Irish company, was it?
It was,
yep,
yeah.
Yep.
It was based in Atlanta, but run out of Ireland. But then the other one, is Vertiv Holdings. This is liquid cooling systems too. We know the Blackwell chips from NVIDIA and then the 325 chips from AMD. They just produce a lot of heat, and you've got to offload that out of the systems. And so Vertiv is a big company that's doing something cool like this. But then there's also smaller companies like Tecogen and others, which are doing cogeneration for the chillers to pull all that heat out of the entire system. So lots of different ways to play this, James. I think at a high level, that chart kind of says it all, that when demand is here and supply is here, that's the incremental opportunity. A lot of these companies were just boring industrial companies 5 years ago, and now they're kind of, some of the sexiest stocks in the entire market right now.
And so if someone's watching this, just a regular investor saying, I want to do AI, perhaps rather than betting on which of the platforms will win as they battle it out for dominance, you could just take the side pocket way or side route with a picks and shovels company that just supplies power, because no matter what, the winner is going to need more power. period.
These are huge projects. A data center used to cost $20 billion to build. Now they're $40 billion to build. And the ones that are being discussed are going to cost over $100 billion. I mean, there's a lot of opportunity. $100 billion from one data center.
Yeah, for one building. I mean, even for Elon Musk, that's a lot of money. Amazing. All right. Well, you mentioned a stock, and we're going to get to stocks in just a minute. I wanted to just see, we got a few little random stories this week. One of them is the penny dies at 232 years old. Canada stopped their pennies in 2012. We finally stopped ours. I mean, obviously, as a unit of exchange, a penny is not very valuable. I don't have any particular sentimental thoughts on pennies. I don't know if you guys do, but it's just economic news.
Well, it's the war
like,
on cash, isn't it?
War on cash. Yeah. EU, speaking of which, is going to require, as of the end of this year, is it, or sometime very soon, any cash transaction above $10,000 is going to be not just disclosed, but actually forbidden. Means if, and I wanted to buy your car and we're both living in Europe for 10,000 and I guess 10,000 euros directly, let's say 10,000 euros, not dollars, I should say, we couldn't do it. And so that stops the money launderers, but that also, technology always affords more power to governments, period. Now, it's always been that way. We look at the U.S., and I'm going on a weird rant here, but the Second Amendment about right to bear arms, that made sense a long time ago when it was the arms in the hands of the everyman, the U.S. having a militia that allowed the U.S. to rebel against the U.K., against England, and become independent. But do we necessarily want our neighbors having bazookas and germ warfare in case we need to rebel against the government? I don't think so, right? So
I am 100% in favor of the Second Amendment.
Gotcha.
Okay,
I mean, I grew up shooting guns, and so I'm not afraid of guns. My point being, though, that the real point, I got distracted, I guess, in that monologue, but as technology has evolved, it just, whether it's weapons, whether it's computer technology, whether it's economic technology almost always affords existing governments more power. And I guess you could argue that that's not good, but like it's maybe better than the alternative. I
really don't think it is better than the alternative. Right? If you have governments that get more power as a result of technology, then you absolutely need to have your own gun.
Got it. Well, so
even guns aside, the worse it is for you.
Yeah, but I mean, I guess what I'm really getting at, and this is an interesting topic here, is would I rather a government have a power or a private large technology company have the same power? If I had to choose, I would bet on a government being more stable than, let's say, frankly, something run by Elon Musk, right? A guy who's, depending on how he wakes up and feels that day, the wind may blow in a particular direction. I'm sympathetic to what you're saying, Owen, that the government can have too much power. And I don't know how I feel about the EU cash ban, just going back to the war on cash.
I used to work for Bloomberg, and all my accounts were in Luxembourg.
Yep.
And every August, you would have a massive line of Winnebagos on the road from Germany to Luxembourg. And it was just a massive traffic jam because all of the people who were hiding their cash in Luxembourg would go there, take their cash out of the bank and drive to the south of France or the south of Spain. So Europe has a real problem with money laundering. And it has private banking rules that are outrageous when you have very accommodative banking rules. And you think about this. France is a very, socialist country and very high taxes. And on the border of France, you have Andorra, Monaco, you have Belgium, Luxembourg, and Switzerland. All have a land border with France, and they are all private banking centers. So yes, the EU has a massive issue with people not wanting to pay the taxes, but they never think about why. Maybe the tax is too high, and you would have more compliance if you had a more growth-centered and forward-looking economic model.
So where do you come down then on the 10,000 euro cash ban? It sounds like you're making an argument for both sides in a certain sense, right?
Well, I think if you live in a country, you obey the laws. So money laundering is illegal, and there is no getting around that. I do think, though, that banning cash transactions is an attack on freedom.
Because if I'm
my money, I should be able to do with it what I want.
And if I'm, let's say I'm an aggressive lawmaker, and I notice that Simon is saying some stuff on Twitter that I really don't like, and I want to restrict his bank accounts, that's bad, right? I mean, at least I would think that's bad, right?
I have friends that that's happened to. So, yes, I definitely think that is bad. That is additionally an attack on freedom. But Europe does not have the same kind of laws about freedom of expression that we do here in the USA. So it's not technically against the law over there to muzzle anybody.
Interesting. Simon, any strong thoughts before we go to our more lighthearted next story?
I'm long the penny now, James. If there's a fixed amount of supply, this is the next Bitcoin is the penny. Stockpiling them under my mattress as we speak.
All right. So in much, much lighter news, the Trump administration may bring back the food pyramid. At first I saw this, I said, oh my God, how terrible. What a terrible headline. We all hate the food pyramid, at least when I was a kid. You eat tons and tons and tons of carbs and pasta. And it was created by lobbying from the grain industry. But actually, the real truth is just bringing back the notion of a pyramid, but the percentages will be adjusted to add more protein. It's a bit controversial. So rather than step into that, what would you guys put at the top of your food pyramids? Like, I'm just curious what you guys like to eat.
At Halloween, the pyramid is actually inverted. Where the
totally.
One with all the sugar and candy is the most consumed around here.
Oh, and favorite food? You got one?
Well, I have to say I'm a very lucky man. My wife is an excellent cook. And double braised pork would be one of the things that I particularly like. And when she wants to be really nice to me, she cooks mapo tofu from scratch.
Mapo tofu, okay, yeah.
That is effervescent. I mean, it is fantastic, but I don't get that all the time.
With the pork crumbles on top, or the vegetarian version?
Oh God, no! The pork it baked in, and but also it's the layering of the spices that to me is heaven.
And I know you're Irish. My dad's wife actually is of Irish lineage, and she jokes that the shortest book in the world is the Irish Book of Gourmet Cooking. So it sounds like you've done lucky to get someone who makes good food.
The joke in our family is you can go anywhere in the world, you'll find a Chinese restaurant, but you'll find an Irish bar.
That's true. Yeah.
So eating is not our forte.
All right. So speaking of stuff that might be closer to our forte, we are stock guys, and part of this show is we bring you 3 stock ideas or just general investment ideas, even if they're not actual stock ideas that we're looking at. Simon, I will let you go first this week. What is on your dashboard?
Yeah, James, I'm going to go with DraftKings. DKNG is the ticker on this one. This is a online sports book. It's for sports betting in the states where that is legal. You can just do it on the app. You can bet for your favorite teams and the outcome of the events. It's come under fire here in recent months as a new wave of competitors called prediction markets are opening this up to the states where DraftKings was not previously available. You could now have a financial product that is tied to the outcome of sporting events. Now, why is that different than online sports betting? It's exactly the same thing, James. It's just that the prediction markets are federally regulated
by the CFTC, right? Yep.
Correct. And available in all 50 states and DC, whereas online sports gambling is only available on a state-by-state basis, including not here in Texas. So Owen and I can't even use DraftKings. But, this was originally interpreted, in my opinion, as a real negative. You'd have a new wave of competitors. Maybe that's going to take market share. I'm reevaluating this. I actually think this is a new incremental opportunity, especially now that DraftKings has launched its own prediction markets product, also partnered up to do the betting odds for ESPN, for their app and for their online sports betting, and then also just doubled its repurchase authorization for the stock. A lot of good things going on. I've kind of reevaluated it. Probably worth taking another look at, and maybe even a company worth betting on, DraftKings.
Nice. So it's down almost 30% this year, just about 29% as we're talking. It's essentially a regulatory gamble. That's the heart of this trade, would be, even though sportsbook official betting is kind of the bastard child of betting these days, and prediction markets, which are sort of the same thing, are okay. This thing could just repackage itself as a prediction market and to be okay too. Is that accurate?
That's exactly correct. They've done a lot of lobbying on a state-by-state basis saying, hey, let us bring in tax income for your state if you allow online sports gambling. Now there's a federal oversight for the prediction markets, which actually have favorable tax treatment in a lot of ways compared to online sports betting. So it's an evolution of the industry that is still very heavily regulated.
Owen, what are you looking at?
I'm looking at Diamondback Energy. So natural gas producer, and very focused on the Permian. So that is, I think, a big growth industry. Natural gas has been depressed in terms of pricing for about 15 years. And the nice thing about these kinds of commodities, when they're totally essential to the global economy, we come up with new ways to use them. So the exports for LNG terminals is running at about 16 billion cubic feet a month. And that's just LNG. Now, when we talk about all of these data centers, well, they're getting hooked up directly to the natural gas network. They need to run 24/7. And the nice thing is that with a single cycle natural gas fired power station, they might not be the most efficient. The combined cycle are more efficient. But you can build one in about 12 to 18 months, whereas it takes about 5 years to build the combined cycle. So we're getting a big upswing in demand that's happening as a result of this data center boom. And then you have the broad economic environment where there's just a lot of investment in new supply in order to cater to the rising population. And the share has done nothing for 6 months. And natural gas prices are just starting to rally. And then we have all of the large energy companies. They're now starting to invest because we're seeing a lot more of the big pan-global organizations talking about that there's going to be an ongoing need for fossil fuel and that it is going to stretch well beyond 2040. Well, you have to start building today if you want to be able to supply in 2040. So the investment cycle in the fossil fuel industry is turning, and that is likely to be beneficial for these kinds of companies.
Yeah, down almost 20% over the past year, but up very nicely over the past 5 years, 338%, roughly speaking. And for someone who's not familiar with the space, yeah, we need all this power, like we talked about. Nuclear sounds great. Nuclear is cool again, but it's going to take a year, 10 years to 12 years, let's say, to bring a new nuke online, even if everything goes super well. And there's a lot of people who are going to be against any new nuclear power. Can't build new coal in the U.S. Nobody would be okay with that. Wind, solar, geothermal, those are like great for what they are, but they're not like enough. And they're often far away from sources of power, far away from where the power is actually needed. So natural gas, like you mentioned, 18 months, you could have one up and running. That is like super quick in the time scale of energy projects for generating electricity. So natural gas is basically the backbone of our energy system currently. I don't know if it's 50% of 40 something percent of U.S. energy electricity now is from natural gas, if I recall, Owen, off the top of my head. Years ago, I remember when it was 15 to 20%. I remember when coal was the backbone of energy. Now coal is sort of like popping off the grid by attrition. These coal plants are ancient. Natural gas is really the only anchor we have, and probably will for 10 to 15 years before those nuclear plants that are in discussions now can even begin to come online.
100% agree.
Yep. So I'm just making a pitch for your stock, basically. So on my end, the company that caught my eye, and I'm going to apologize for seeming like I'm taking the moral high ground here on this company, is the ticker is IDEXY. Let me share my screen. What I do here? I hit a wrong button. This is Industria de Diseño Textil. I did not. I took German in school, not Spanish. This is the parent company of Zara, the cheap clothing store you've seen in the mall if you go to the mall. The stock has been a very good stock overall. The company typically delivers 30 to 40% ROIC. It's very consistently profitable. I also like that the head of the company, or the founder, Amancio Ortega, controls about 59% of the voting shares. It's basically one of these founder-led companies with family on the board. And that sounds bad at first, but founder-led or family-run companies actually outperform statistically. So I like this company on a numbers thing. But in terms of human rights, this company has repeatedly come under fire for either forced labor in Xinjiang, slave-like conditions in Argentina and Brazil, wage theft in India and Pakistan, environmental problems, human rights problems. So I'm not like the hugest believer in ESG or SRI type of investing. I think the free market is a better way to sort things out, and I think it's very hard to assign numbers on things. But this is an example of a company, and I chose this deliberately, where I would rather walk away because I like the numbers on a company, and someone else may see this in a different light, and I respect that different light, but I just don't like how these guys play in terms of repeated problems. And when you're making super cheap clothing, fast fashion, you got to be always looking to cut corners and do it as cheaply as you can. And it looks like they may be a little bit too aggressive in doing that for my tastes.
And they've also got Shein to worry about.
Exactly. Yeah. Someone else, who probably also using forced labor, probably even more forced labor.
But that is a major competitive force.
Yeah. Yep. Totally. All right. So with that said, let me bring on Xiaoping Wang, our analyst, with a few questions.
Hello. The first question is from Alicia. Is this an opportunity to buy Bitcoin on weakness or stay defensive?
I'm the stay defensive at the moment.
Okay. The second question is from Christine. Should I be reducing exposure to mega cap ETFs right now?
I would say that depends on how much of it you've got. If you're all in it, maybe you might want to take a little bit off. If it's a small weighting, then you got to you have to think about what your perspective is. How long are you going to be in this thing for? Is it a trade or is it an investment?
And when you sell something, you do something else with that money, even if it's literally just letting it sit in a money market fund. So what is that something else? I will say that if I were putting new money into the market just blindly without knowing about Christine's allocations, I would put it more into an equal weight S&P index fund. I think there's just one that charges like 22 basis points a year. So the fee, it's not crazy expensive, but it's a lot more than whatever it is, 3 to 5 basis points, whatever the market cap weighted indices are. But I would still favor that one over a cap weighted index for new money right now. Simon, you were going to say something more salient, I'm sure.
We can't give personalized advice, but just by the numbers, the cyclically adjusted PE ratio is the barometer of how expensive the S&P index is. It looks back at 10 years of earnings and normalizes those. The S&P 500 right now is at the second highest CAPE ratio it's ever been. The only time it ever was higher was right before the dot-com crash in 2001. Which is my short answer of I would stay away from large cap indexes right now.
Yep. And the asterisk, there are certain structural reasons this time may be different in the sense that companies are using less and less fixed leverage. They're more profitable than ever before. These are true things, but you can't get too far away from mean reversion in the markets. At least nobody has so far to date historically.
Okay, the third question is from Zoe. How long could the AI-driven energy boom last?
Oh, long time, Zoe. We're in the earliest innings, of this. If you look at the projects being announced, OpenAI, love or hate Sam Altman, he is the world's best salesman right now and drumming up interest. There's James and I have mentioned several times $1.5 trillion of existing planned infrastructure spend, coupled with $364 billion of actual spend this year from the large hyperscalers. I mean, we're still just getting started.
Even without AI, the U.S. was finally seeing electricity load growth, like meaningful growth for the first time in like 20 years. Meaning even without AI, we're a little bit short on power with EVs and just population growth and failure to build power plants. And nobody wants a power plant near them. And so we just don't tend to build them that much. And it's pent up demand. So yeah, I agree with Simon very much on that.
Okay, so the last question is from Tammy. How do I invest in natural gas related AI plays without taking on commodity risks?
Natural gas is a commodity. So it's very hard not to take on commodity risk. But if you don't want to go on a producer side, then you would go on a transportation side. So then an MLP or a pipeline company would probably be the best way to go.
Yeah, MLP, Master Limited Partnership. If Tammy's not familiar, they basically ship gas, oil, whatever, either within a state or state to state. And if it goes state to state, it's regulated by the Federal Energy Regulatory Commission, which for some reason has always been a little bit lenient on the rates they can charge. MLPs were a staple of my stock recommendations when I ran a dividend newsletter for 10 years. So I know the sector pretty well, and I agree with Eoin. It's probably a good play, and I think that the MLP valuations are attractive right now also, Tammy.
Okay, that's all of the questions. Thank you.
Excellent. Xiaoping, are you a little bit sick today? You sound hoarse.
Oh, really?
Sounds like you're not sure. So, all right, guys. Eoin Tracy, Simon Erickson, potentially sick, Xiaoping Huang. Thank you so much for joining us. It's always fun to do this show. We'll be back next week. Send us your emails, send us your questions, send us your comments, critiques, complaints. If my jokes go too far, I'll read them.
So I'll be sending those, James. Those will be coming from my email.
Next week's going to be more, Tim. I decided that right out of the gate. But you got to try. You got to try. Anyway, thanks guys for doing this, and thanks to you guys for watching us at home. Awesome.